Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit RoyMatlockJr.com. Now, here's your host, Roy.
All right, Roy Matlock Jr. here, and we are talking money again, and we always do it every week. And if you're tuning in right now, today's going to be a good show, especially when you as we go into the end of the year and we see stock markets at an all-time high. The number of highs that it's hit is just unbelievable, and you want to make sure that you've got your stuff in order. And so I'm going to be talking about kind of some buckets, and we talk about buckets of money. We've got risk buckets, we've got tax buckets, we've got lump sum buckets, and then we've got other things that are monthly buckets. And I'm going to get into all this kind of stuff with the idea to put your financial safety system in place. And, I think this is an important show for any of you, especially if you're within 10 years of retirement. If you're younger, market dips, short of you not having an emergency fund, really are nothing more than benefits to you. You're like, I wish the market would go down for the next 20 years and I'll just keep buying every month. And then what's going to happen? It recovers, which it never stays down that long. But if you do that and it recovers, you've made profits every month. And we're going to talk about that and how that works. But most importantly, we got to get the system in place. I kind of believe there's three stages in life. You've got the early getting started stage. The most important thing that you can do, and the biggest mistake people make, is something called procrastination, and that's you never get started. And even if you do nothing more than set up a $100 a month mutual fund, we do those kind of things for people. I have a lot of clients that, they want their kids to get on track. And I said, look, let's get them saving money every month and automate it. And, $50 or $100 or $200 a month, whatever it may be. One of my nephews, my niece's son, or nephew's son. Anyway, the point being is multi-generational type things. And I just got a text. I got $500 more, and he's in high school to put in his fund. And so what happens is you get people excited about that when they're young and getting started, and you do it before they're teenage. When they're teenagers, you show them how it works. So we do that, and then we move into the that getting started stage. Mostly, the getting started stage is get a draft set up and work on growing your income. And every year when you get to the end of the year, look at where you're at and turn right around and bump that draft and, fully fund your retirement plans where you're getting matching funds and you're on your way. Then we move in the accumulation stage. That's where we start seeing people change jobs, have rollovers, they have lump sums they got to deal with. Maybe your income is moving up and you've got cash that's sitting in a bank account that you don't need to have sitting there, but at the same time you don't want to roll into the market and then something go wrong. And then we go into the retirement income stage, and that is a whole different mindset. That's when you're having to make sure that your income lasts and it doesn't run out, and it's very important in the way you handle things. So anyway, we're going to start with that. We've got three buckets. So let's start with the first bucket. Bucket number one is your defense bucket. That's going to be things like cash, money markets, annuities, CDs, things like that. I'm of the mindset that a CD, tying up your money in a CD, generally is not the way to go. You can go into a money market account or a bond fund, but either way, these are considered what I call the safety or defense buckets. And so what does that do for you? Well, when you have an emergency fund, you avoid paying penalties, you avoid paying, selling at down markets, things like that. When you are retired, you have a fixed, if you buy an annuity, you get a fixed income that you can count on every month along with your Social Security, and that allows you to start living normal. And then you have your buckets that are in investment type products that allow you to buy the dip, or in the case with what we've been doing all year is when we do RMDs, we're pulling from the from the risk buckets, the ones that have grown the most. And so typically when I start people out, when we get started and when they get to retirement age, we're going to look at these risk buckets. We're going to get their income and their Social Security and their and some type of fixed income, might be an annuity, that kind of deal. And then we're going to keep probably 2/3 of their money in something that has some growth opportunities to it, along with some bonds and cash and stuff like that. And that's the middle road would be bonds, balance funds. You may have rental properties, something like that, designed for steady yield and things of that nature. And then we go on our growth or offense buckets. That's your stock funds, your ETFs that drive long-term growth. Now, if you look back, and we go back 100 years, the stock market's averaged about 10%. But in doing that 10%, here's what you got. You got to live with the fact that it's up 3 years and down 1 year. And you may, if you come in with cash, happen to be buying into the 1 year that it started down. So, and if we have a big down, you may be putting in your 100 grand and it's 80 grand. So there's other ways to approach those kind of things. We're going to be talking about that. How do we get into those things and do it the right way? But the most important thing you need to know about your risk buckets is that your risk buckets are designed to keep you from doing one thing. And that one thing is to buy high and sell low. We don't want to do that. We want to make sure at any given moment when we have stock market declines that we have other monies that we can pull from. And that allows us also during those declines to possibly buy into the decline. I would always rather buy at a discount than buy at the top. And then what we do, we don't know where the top's going to be, so we bring it in over time. So if you have cash right now, what I typically do is I bring cash in over a period of time. If someone is in a retirement plan through work and their investments right now that they have sitting are going to be the most important thing to their retirement, then we're going to probably be a little more conservative, and then we're going to be buying in on the discount. And what that means is that the monthly investments, we hope we have volatility and we can buy on the down, but on the money that we've already got, we'll get into more of that. We may be a little bit more conservative if you're at market highs and things like that. So this is what we do. This is the beginning of what we call risk buckets and tax buckets. When we come back on the next segment, I'm going to talk about tax buckets, and then we're going to, third segment, talk about how we put risk and tax buckets together to make for an optimal plan. My name is Roy Matlock Jr. If you would like a free consultation, a 15-minute phone call, you can go and schedule that at roymatlockjr.com. We will be right back. All right.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit roymatlockjr.com. Now, here's your host, Roy.
All right, if you're just tuning in, my name is Roy Matlock Jr., and we are talking money. Been doing this for 40 years, helping people get their finances straight. And you want to go to roymatlockjr.com and listen to the podcast. There's more information on money sitting on my website for many, many years of real life. I still meet with people, and I have advisors that meet with people. And, you know, I'm pretty much a lifetime learner. And so as a result of that, we've got good information. You can search by anything, a lot of good downloads. And if you'd like to do a 15-minute phone call, you can call us at 615-843-2999 and set it up, or go to roymatlockjr.com and do that. Today we're talking about risk buckets, tax buckets, how to handle market highs and what should you do, how should you handle your money at the different stages in your life. And so in the previous segment, we talked about risk buckets. That's your stuff that is your conservative defensive. That would be your cash, your annuities, different things like that. Then you got your mid-range, which would be balance funds, stock bond funds. And you got your growth buckets, which could be, growth funds and, ETFs, different things like that. And so now what we're going to do is talk about tax buckets. And that's how to keep more of what you make. So let me give you an example. When you think about your biggest expenses, the first thing you got to ask yourself, what is my biggest expense? And a lot of people say, what's my house payment? Or maybe I've got a car payment or whatever it may be. But in many, many cases, if you're six figures, combined household income or more, it's very possible that your biggest expense is something called the difference between gross pay and take-home pay, and that is your taxes. So your taxes are there, and the government says we have tax laws, and these tax laws are designed for you to do things that benefit you, and it will cut your taxes. But if you don't do them, they don't call you up and tell you, oh, by the way, you missed this. And so one of the things that I do is I always like to, make sure that I'm taking advantage of what the real effect is. So we've got three buckets. We've got a taxable bucket, we've got a tax-deferred bucket, and we got a tax-free bucket. All right. So how does this work? Well, a taxable bucket would be bank accounts, brokerage accounts. They create 1099 income, dividends, interest, all that kind of stuff. So it's pretty easy to understand. But one of the rules that I try to tell people is never pay taxes on money you're not currently using. You want to have an amount of money set aside to allow you to have access. Generally, if it's taxable, it's assessable. If it's some type of tax benefit to it, it's going to be some type of penalty to be able to have that money. Now, so you say, well, I don't want to be penalized. Well, we never want to be penalized, and the way we do that is we make sure that we have some taxable, accessible money. But we don't want to have taxable, accessible money that is over and above what we need. All right. Generally an emergency fund, maybe a little bit of what we call opportunity money. That means quick access, that you have access to money if you could do something and have a quick turn opportunity, whatever it may be. So we have taxable accounts, bank accounts, brokerage accounts, things like that. Taxable equals accessible. Too much in the taxable equals you're paying and working your life. You go to work every week in order to pay the taxes on the money you're not using, which makes no sense. So we want to get that into some type of tax-deferred account. How do we do that? Well, the first thing is, of course, our retirement plans. They grow tax-deferred, and in many cases, they become tax-deductible. So let's explain how a tax-deductible plan works. If you've gone into a store and they say, buy one, get one free. Well, if you put your money into a 401k or a deductible IRA, and mostly what I tell people is your 401k, or if you're self-employed, your SEPs, whatever it may be, and you put in $20,000 and you get a $5,000 tax deduction, that's $5,000. So it only costs you $15,000. But if you invest in your mind, I can invest $20,000. I can take the 20, put it in, it's deductible. The $5,000 I get back if I'm in the 25% tax bracket. I could stick it into maybe a Roth IRA or a backdoor IRA, Roth IRA, in the event you make too much money. You just bought one and got one free. You bought the $20,000 401k plus got matching. The tax savings you can throw into a Roth and it grows tax-free. You bought one, you got one free. That's pretty cool. All right. In addition to that, you get, generally speaking, if you work for a company that have a retirement plan, 403b, 401k, whatever it may be, you're getting matching funds. So that is just a no-brainer. It grows tax deferred. At some point in time, you will have to pull it out. IRAs are the same way. If you have a traditional IRA, it will grow tax deferred until you pull it out. Then you have to pay the taxes on it. But the way you look at it is this: this is $5,000 that we have that's growing, and if you get 10%, Every 7 years, that $5,000 doubles. So it goes 10 grand, 20 grand, 40 grand, 80 grand. And then you have to pay taxes on it. And if you're in the 25% tax bracket and you have 80 grand, you would have to pay 25%, which would be 20 grand. Well, what happens? You just made 60, and that was free money as a result of just taking advantage of a tax deductible account. All right. So what we do is we do that. We have annuities. Annuities grow tax deferred. So why do we use an annuity? Well, we use them for a couple of things. We can use them for income. That's what lifetime income guarantees are. It protects you against longevity risk. I've had people say, well, I don't want annuities. Annuities, there's fees. Well, the reason there's fees on annuities is because annuities have other benefits that things that aren't tied to an insurance company don't have. So let me give an example. If you buy an annuity and you sign up for an annuity with a lifetime income guarantee, here's what's going to happen. If you live to 102 like my mother, and the money has already run out, they will continue to pay you as long as you live or as long as you and your spouse live. That's why we buy an annuity. We also get tax deferral. We can go into what's called a variable annuity or a RILA, and we can put in as much as we want into that account. And if we don't touch it, it will grow tax deferred forever until you die. And then your people that inherit that can get tax benefits on the inheritance. So we do that for people that have money they don't need. Now, generally speaking, anytime it's a tax benefit, there's penalties. There's early withdrawal penalties. So if you go into an annuity, generally they have surrender charges. So if you come out early, typically 6-7 years, all right, you're going to pay a penalty. If you pull it out to prior to 59 and a half, you pay a penalty. But you would never pay a penalty if you have taxable buckets because you have your emergency money that you would draw from, and you might even go as far as to get a home equity line of credit. That's another defensive position, which allows you to have a place to draw money, which keeps you from paying penalties. We have tax-free buckets. All right, what is a tax-free bucket? That would be a Roth IRA. It would be a Roth 401k. If you have life insurance, you can borrow against that life insurance and get that money out tax-free. You can also take a loan against your house. That would be your equity line of credit. Any loan is tax-free, so you can borrow against it. A strategy that a lot of people I know that own real estate, they will refinance as the rents go up and the equity goes up. They'll refinance, cash out, and the rents pay the payments, and they pull out tax-free cash. So they refi and they pull tax-free cash out. And that's how people that you hear that have high net worths, that they say, well, they don't pay taxes. Well, they're just using the tax laws. They may take a loan against their brokerage account, and they're able to pull cash out and keep their money invested, or a loan against their insurance policy, or a loan against their house, and they can do things and invest that money as well. So those are tax buckets. So what we do is we use all three of the buckets in order to control our taxes and move forward. And that's what we do. Our business is the business of helping people make good choices when it comes to their money. My name is Roy Matlock Jr. Visit roymatlockjr.com and look for our webinars. We do them every single month to help you get ahead. We'll be right back. All right.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit roymatlockjr.com. Now, here's your host, Roy.
All right. Roy Matlock Jr. here today. We're talking about tax buckets, risk buckets, different things like that to help you really just be calm. You're supposed to be calm when you retire. You're not supposed to be worried. You're not supposed to be worried about retiring one day. You're supposed to have a plan. So we're going to be calm, and we're going to be on track, and we're going to do things the way that give us outcomes. Actions have consequences. If you do certain actions, you get certain consequences. You get good outcomes if you do the right things. And so what we do is create a calming effect when it comes to your money. How do we create a calming effect? We have a plan. A plan puts you in place to where when the market goes down, you're saying, that's okay. I've got a certain amount of money over here in accounts that don't go down. This may be an opportunity for me to buy at a discount. If the market goes up and you're retired, you say, this is great. I'm going to pull from some of that. And then I'm going to pull off the profits. So what am I doing? I'm selling high. I'm buying low. I'm doing things like that so I can be calm and I can look out into the future and say, I got my list. And matter of fact, we're going to be coming up our next webinar. If you go to roymatlockjr.com, we do them once a month with the goal of doing two things, getting you educated and that gets you calm. Then when we have conversations, if you're clients of ours, you're like, yeah, I know what you're getting ready to tell me. You've been telling me the same thing every time. I'm like, that's right, because we have a plan. And so our next webinar, when you go on there, is the checklist. The checklist to be calm, to have a plan to where you know the outcome, and that's it. We're going to check off all the boxes. That's the next webinar coming up, checking off the boxes to know that you've got it going from the defense to the offense to where you don't worry about it anymore. You just make sure and follow through on the stuff that we put in place and you're off to the races. So now let's talk about time versus timing and why we're not going to be worried about market declines. We're not going to be worried about excited about the market going up. We're not going to be looking every day at what's going on. We're not going to be looking at the, market and say, what did it do today? How did that do? I lost this much money today. I made this money today. No, we don't do that. Most of the time with me, I have clients many times tell me things and they're like, what did you think about the market today? I said, I really didn't look at it. All right. And they're like surprised thinking that that's what I do. I don't do that. All right. That's not my job. My job is to manage long-term things. Daily doesn't matter. So let's talk about time and timing. Time in is the key. And when you do that, you invest consistently, you leave the money in, you ignore the noise. You don't worry about all of these different things. I remember back during the pandemic, okay, you don't understand the market. This is a pandemic, all right? And then guess what happened? The markets performed just like they always did. When they made the drop, they recovered. And for people that stayed in, it was fine. Time paid off. If you look back in 2020 where the market was versus now, it worked out. So the most important thing is time, not timing. Now, if you are using that and understanding that and time in, you invest consistently, you continue to put your money in, and you ignore the noise. If you try to time it, you jump in, jump out, you wait for the perfect moment, and most of the time, it loses compounding. And if you look back over the last 30, 40, 50 years and consistently, no one knows how to time the market. We do know some things. Some things we know that maybe the market's at an all-time high, and if we're buying in aggressively into the all-time high market, we might be timing it bad. If we're buying into a down market, we might be timing it a little bit better. But we don't know what the bottom is, and we don't know what the top is. So what we want to do is protect ourselves by having time and having money in places that doesn't get affected by the market. So you don't need to predict. You just need a plan. And if you want to do some real research, go onto the internet and look back and say, over the last 20 years, if I was out of the market, the 10 best days of the market, what would the difference be in the rate of return? And it will blow your mind what happens if you miss a good day and you miss 10 of the best days over a period of time because you're trying to time it, and it typically cuts your return in half. Corrections are normal, crashes are opportunities, and the market always recovers. What we want to do is have a plan. That's the key lesson to it. So let's recap. To start with, we have tax buckets and we have risk buckets. Risk bucket is we have our conservative money, our mid-range money, and our aggressive money, otherwise known as stocks, bonds, and cash. We throw annuities in there, which fall in kind of the, depending on the annuity, in the bond or the cash side. And then we have growth, which would be the stock market and things like that. All right. We also have other buckets of money, which are income buckets that I didn't mention, and that's how you make your money. And we want to always diversify our income. We have tax buckets, which are taxable, which are assessable. We have tax deferred, which typically have cost and penalties to them. And if you or have tax-free, those will be Roths and things like that, or loans. So anyway, so that's how we do there. Then what we do, we put the money in, time, and make it happen. So now let's talk about how we go about developing an asset allocation model and an automatic financial plan that works. So the first thing is something called dollar cost averaging. Dollar cost averaging is set aside the same amount of money every month, and you purchase every month with no regard as to where the market is. Same amount monthly. It buys more shares when the market drops automatically. So you're getting an automatic discount system. Think about that. Automatic discounting system. So when you are putting money in and you hear the market is down, you're like, I just bought. How about that? When the market is up, you bought less shares at a higher price. So you bought more at a lower price, less at a higher price. And all you have to do is get it set up. That's what a 401k does. That's what a monthly draft on your checking account does. You don't have to time it because it's automatically doing it. It's buying less shares when the market's up, more shares when the market's down. It reduces regret. It removes emotion. It creates consistency. It becomes a foundation of long-term wealth, which is automating your financial plan. Think through that. How simple would that be? All I'm going to do is I'm going to say to myself, all right, once a year, we're going to analyze our income. We're going to make sure that we're putting aside 10 to 20%. If you're really aggressive, 25% of my free cash. I'm going to take advantage of all of the tax deduction I can, tax-free. I'm going to get tax-free Roth IRAs or backdoor Roths if I make too much money. I'm going to do my 401k, get my matching funds and deduct it. Buy one, get one free. I'm going to take, if I'm self-employed, I'm going to do a solo 401k or a self-employed pension plan, simplified employee pension plan called a SEP. We're going to do that. We're going to automate it every month. We're going to make sure we have defensive money in place to where if the market's down or if we have an emergency, we've got our system in place. We've got emergency money. We pull if we're retiring from our guaranteed type things. If the market's down, if the market's up, we pull from the stuff that's up. I mean, it's just a plan. It's what it is. And if you don't work with someone, then maybe this is Greek. Maybe it's not something you do. I always look to professionals to help me do things that I'm not as good at. All right. And that's what we do as a company, Roy Matlock Jr. Advisory. We are a fiduciary and we work with all companies and we're not tied to any one place. If you'd like help, reach out, go to roymatlockjr.com. We'll be right back with our last segment.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit RoyMatlockJr.com. Now, here's your host, Roy.
All right, we are segment 4, and if you're tuning in, this is the Roy Matlock Jr. Money and Business Hour. I've been doing this for 40 years, been on the radio, for over 30 years. And with the idea that education, when it comes to your money, will pay off. What you don't know will hurt you. And so tune in, go to our podcast. We've got hundreds of shows on there that you can search right at RoyMatlockJr.com. You can put in a keyword and you'll be able to learn whatever you want to learn. And if you think about your personal finances, the only thing that's more bothersome than being broke is being unhealthy. All right. And if you get yourself in a position financially to where, it's really more of a situation that you're in rather than, some type of major catastrophe. Most major catastrophes, 50 grand would fix. All right, generally speaking. And if you had the 50 grand, you probably wouldn't be as concerned about it. And that would be like liquid cash if you had that kind of stuff. And then you have your retirement plans. So what we want to do is put ourselves in a position to make it happen. So now we're going into the markets. You say, what do we do at market highs? How do we manage that? How do we go in? And the first thing we do is we use dollar cost averaging to accumulate money. And that's where every month you put it in. Then we go into asset allocation. That's stocks versus bonds versus cash. This is going to determine 90% of your long-term return. We do asset allocation based on age. That's one starting point. So if you're young, you're going to probably be more aggressive. If you have, then we start looking at, if I meet with someone and they come to me and they're like, all their money's in the bank. All right. And they've been like that. Well, in that case, their risk tolerance, I'm going to be a little more conservative in dealing with getting them into something that's better for them. So if they come in and 100% of their money's in the S&P 500, they've been riding it and all that kind of stuff, then I know their risk tolerance is a little higher. However, I'm probably going to back them off a little bit if they're near retirement. So we do that. We look at the time horizon, and that's going to determine when you need the money. If you have a long time horizon before you need it, that means we can ride out market cycles. And so if we have a 6-year market cycle, we can ride it out if you have that. But if you're getting ready to pull money now and you're 65 years old and you're getting ready to retire, we don't want to have all your money sitting in something that would take a 42% hit like in 2000, from the 2006 high, something like that, or the tech crash, whatever it may be. So we're going to make a change on that. This is all part of asset allocation between stocks, bonds, and cash. And we throw in that bond cash, we throw annuities in there if you're a retiree or if you've got extra cash that you want to defer and not pay taxes on. We look at your income needs and we do that. And then what we do after that is we rebalance and we look at, if you're retiring, where are we going to pull from this year? I have these meetings on a consistent basis with our clients to where we're like, all right, this year we're doing the RMDs and the RMDs are coming out of this bucket. Next year it may change. We may come out of this bucket. We may reallocate. We're a little heavy right now in stocks because the market's up. So we may back off a little bit, move some of it around. And depending on if it's in a retirement account, we can do that. All right. We can also reallocate based on stuff that's in a retirement account. We could say, well, that we can move around any way we want to do it, but we don't want to move around the taxable buckets because it creates a tax situation. So we do that. We look at all these different things in creating what we call the right asset allocation. And really it gets back to the person. All right. I have certain clients that I've dealt with and I know how they are. And what I want to do is I want to take you to the level of risk that you're going to stick with it and you're not going to get really, really bothered. Now, we have to take on a certain amount of rate of return and risk to get the rate of return, or we will have another problem, and that is that our money doesn't buy enough anymore. Inflation comes along And if you don't have something that's growing, keeping up with inflation, you see your income staying the same, but your purchasing power going down. And so this is our asset allocation model. And when I meet with someone or any of my advisors meet with you, what will happen is we'll find out about you. And that's the personalized part that you find out about people, and you see where they're at. If I run into somebody that's got a bunch of money sitting in cash, then that tells me something right off the bat. If I run into someone that has gone and paid their house off, all right, which if you let me just say this: if you've got a low interest loan, a 3% loan, that is not what you want to pay off. All right. No, don't do that. That is as bad advice as anything you can have. Just love the fact you got that low interest loan. Never pay it off. All right. Just let it roll. All right. But anyway, that's just a little side note. So then what we do, we start looking at real life examples. All right. There's been studies done, and ideally the best outcome for an investor is a 60-40 stock bond portfolio. It's been every study done. You say, yeah, but it doesn't do as well as what if I had it just all in the market? Well, if you have it all in the market, that's fine. But if you are like most people, you don't like losing. And I had a client come in one time and I said, you've got all your money in the market. I got an idea that your feelings will get hurt if we have a 42% market drop. And she came back and said, no, I would cry. And I think that's what people actually do. But the problem is they don't just cry. They usually cry and cash out. And then they really cry because as soon as they cash out, they see the market run up again, and then they're worried again. And what they're worried about now is I'm buying at the top of the market. And what's going to happen again? And this kind of scenario goes out there. So one of the things that I've always tried to do when I work with clients is I'm going to walk you off the cliff if you're getting ready to make a bad choice. I'm going to do that. All right. And, that's the way I try to do is make sure we rebalance, we get you in a position. If you're a retiree, we're going to be more conservative. We're not going to let you lose sleep at night, but at the same time, we got to have some risk, and you're going to be okay with it because we got buckets. If we have lump sum investing at market highs, what do I do with clients? Well, I have people all the time. They say, am I buying at the top? All right. And everyone feels this way. There's been plenty of times when you buy at the top. Historically, if you put it in 75% of the time, the lump sum will beat the dollar cost average if we go into the market. All right, 75% of the time. But that doesn't matter if you're in the 25% time. So let me give you an example. You put in $100 grand and you got $100 grand, and we can bring it in over a period of 12 to 24 months. We dollar cost average. We put it in maybe a bond fund or something that gets something better than the bank. And we have some in money markets. And then every month we buy into the market. And if the market's going up, we're buying shares when it's going up. If the market goes down, we're buying shares when it goes down, with the idea that we're going to buy a lower cost per share because we automatically are discounting. We're buying less shares high, more shares low. Now, here's the problem. If the market is up 75% of the time, we don't know the high, and there's a chance that you missed out. Now, you didn't miss out completely because you're still buying, and if you're buying and the market's going up over the next 12 to 24 months, and you're buying every month, you're buying and the shares are going up, you're just not making as much. But if the market happens to go down, which is 25% of the time, you're not sitting there with 100,000 that turned into 75,000 or something like that. And so what we've learned is that for the most part, when the markets are high, we dollar cost average. When the markets are low, we tend to be a little more quicker in bringing the market in. Well, we don't know what the market's going to do, but that's just an idea. I'm fearing I'm buying at the top. All right. So what I do is I always kind of put the strategy together. We do risk buckets first. We look at where people are, and we make those decisions. We then blend lump sums and dollar cost averaging. All right. Depending on where we're at in the market, we may put a little more in or a little less in. But the bottom line is that if you lose 10%, you have to make more than 10% to get back even. So if you have $100 and you lose 10, you got 90. If you get 10 back, you only got 99. So if you lose 20, you got 80. If you make 20 back, you get 96, if those numbers make sense. So what we try to do is make that work. We use tax buckets to reduce friction. We put the right dollars in the right account types. If we are high earners, we're probably going to get the maximum tax deduction. And then later down the line, when you retire, we may look at doing some Roth conversions, different things like that. If we are retiring and we pull money out, we're going to look at the best ways to get the income without having to pay the taxes. So let me give you an example on that. So let's say that you are retiring, and what we do is we pull Roth IRAs. They're tax-free, so you're getting your income, you don't do it. We do reverse mortgages, which allow people to eliminate a house payment, which allows them to pull less on their accounts. We do taxable accounts in many cases, to where part of the money we pull out is return of principal, which keeps all of this with the goal maybe of you not having to pay taxes on your Social Security. So we do all those kind of things. We use corrections to our advantage. When the markets dip, we rebalance, and then we maybe have money that was sitting in some of our conservative buckets become more aggressive. The big lesson is market highs look like peaks, but they turn into lows also. And that's when you want to be prepared to make things happen. So if you're listening to today, I'm going to give you the summary of the show. You can go back and listen to all of the segments on their podcast. Once the show is aired, it goes to podcasts. It's at roymatlockjr.com, or you can look at anywhere the podcasts are, Roy Matlock Jr. Money and Business Hours. So here's the summary: diversification through risk buckets, tax planning through tax buckets, time in versus timing, dollar cost averaging eliminates emotion. Asset allocation determines the long-term outcome, because we want to make sure that we have things in the right place for the right person and the right time period. Lump sum investing still wins, but blend it. If you're nervous, I like the dollar cost average, and the goal is to stay invested, diversify, and stay on a plan. That's what we do. Our business is helping people with their money. If it comes to money, we do it, or we refer it to someone that knows how to do it. My name is Roy Matlock, jr.com. I would encourage you, go to our website. You can do a number of things. You can download all of our resources. You can sign up for our upcoming webinars, or you can schedule a 15-minute phone call by calling 615-843-2999. We'll talk to you next week.